Hey everyone, welcome back to the Old World with Will Tanner. Here we have one of my favorite financial focused Twitter accounts, Dimitri, or Back the Bunny. Yeah, he can explain that in a minute. And we're going to talk about the differing view of wealth between what I would describe as the West's period of greatness leading up to the Belle Epoque and ending in World War One, and then what happened afterward, and particularly in terms of whether it is income generated by wealth that matters or the capital gains on the nominal value of wealth that matters. And because that's a big difference, and it changed a lot in the 20th century. So Dimitri's going to talk to us about it, and we're going to talk about what type of society is formed by each view of wealth. So it should be really interesting. Dimitri, can you introduce yourself?
Yeah. I appreciate the conversation. I'm a huge fan of yours as well. And Twitter just speaks to the value of Twitter and just putting yourself out there, right? Coming into
Hmm.
contact with guys like you. So I have a pretty strong finance background. A bit of a generalist though. I've done B2B sales. I've managed a gym. I've done a fair amount of things and a fair amount of published writing too on like more legacy finance platforms and economic publications before I kind of got more into the Twitter and Substack sphere and just went rogue and self-published, so to speak. And so just think it's higher value, and you end up meeting better people and making cool connections. I've worked in the DeFi space. DeFi, when I say DeFi, that means decentralized finance, and that is the more pure instantiation of crypto. Those are the actual financial rails that crypto transacts and is traded on, as opposed to say like a brokerage like Coinbase, which is just a broker.
Hmm.
You don't actually own the asset. So that's what I mean when I say DeFi. I've been working in DeFi for the last over 2.5 years or so, building a perpetuals dex. That's where my handle, the perpetuals dex was rabbit themed. So back to bunny. That's where that came from. um, and I have since recently left that project. I am now doing some consulting work with a couple other projects right now, and I'm also building something rather unique that builds upon the essays that you have noticed. The essays are actually kind of me discovering something in public, frankly, something I didn't already know when I started writing them, and I literally discovered by virtue of just forcing myself to think about them. And it's come to a conclusion that no one else that I've observed has ever come to, and I'm going to test that in the arena with a business and see how it goes. So
Awesome. Excited to see it play out. Because I'll link the Substack for the people who are listening. They're very interesting essays describing financial history. And it's really the first one that this conversation is going to be focused around. And that's the shift from kind of a focus on dividends and income to one on capital gains. So I'm going to talk a bit at the beginning just to set the stage and then let you go. And I won't talk as much during the rest of it. But if you look at how wealth used to be viewed and how it's viewed now, one of the biggest changes, and one you've written about a great deal, though really the financial commentary, it doesn't discuss it much, is how wealth is valued. It used to be that the income derived by land, and to a good bit lesser extent, gilts or bonds, like the English gilt, is how people viewed wealth. Famously in Pride and Prejudice, which is probably the best known of Jane Austen works, it's Mr. Darcy is worth 10,000 pounds, is what they say. I forget what that translates to, but I think it's around $1 million in income a year. But no one says he's a millionaire. It's not the capital value of his landed estate that people focus on. It's the income generated by it. But now that's very different. Even in similar cases, the Duke of Westminster comes to mind. People say he's worth $9 billion because of his real estate holdings, not whatever the income is that those holdings generate. And land is, I think, the best example of that, just because there's the historical interplay, but it's come to equities as well. And one point you make in your article on intrinsic value is that many stocks, particularly the currently quite popular tech and growth stocks, never return anything to shareholders in terms of cash dividends. In the past, whether it was the VOC or a railroad, the stocks were expected to go up sometimes, but really the value attached was the dividend payments. And you see this in different schemes, like the Union Pacific Railroad. Attached to it was the Credit Mobilier scheme, which is how the investors got all their money out in dividends. And that, of course, was shadier than we'd like, but it was what they focused on. They cared about the income generated by it. So, getting to my question finally, why do people no longer care about the income derived by assets? Why is the focus on the capital value of them rather than the income from it? Or even a mega cap company like Amazon, once it's grown to this huge point, is expected to just continue investing rather than returning capital to shareholders?
yeah, it's an excellent question. I think it's a question that should be examined more than I am trying to examine. I'm working on more essays that kind of also speak to that. But the main one, which is called DeFi's Dividend Dichotomy, the Capital Markets History Lesson on Substack, And it's part two in the Speedrunning Financial History series on Twitter. The substack one essays are always a little more polished and refactored. So there's a two-part answer to that question. And I'm going to start with more of the societal answer and then the company-based answer of how we started with basically viewing stocks as essentially junk bonds. And when I say essentially junk bond, I mean you own a bond for its coupon payment and then it returns its capital at the end of the term. All right, a junk bond is a bond that has a lower likelihood of repayment. It's a more risky company associated with it typically, but it offsets that with a higher yield. Early stage equity, like back in the VOs, the first instantiation of equity, which is East West India Company, ticker VOC. Stock was basically like a junk bond. It was the lowest in the capital stack, so it had the lowest. It was the most risky of payouts, meaning if a voyage, like, and they raised capital to finance a voyage, right? Like we're going on an expedition for nutmeg, and stuff like that. So we're raising capital, we're going off on a voyage. If we're successful, you get paid. And a little fun fact too, dividends sometimes from that time, especially with East West India, sometimes were in the form of spices. So their dividends would be spices, like not even like money. You know, capital is capital, I guess, right? So the notion at that time. So trying to see how I want to frame this. I'm gonna start with the societal answer first, and the company answer. So this evolved over time though, as and people started viewing those more and more, less and less like junk bonds. They started being more and more okay with the capital appreciation element of it. There are some societal shifts, regulatory and legal ones, that frankly I think were the cause of that. Things like land, like you mentioned, like the value of land was the stream you could generate from it, right? And part of the reason why that's the only way you could quantify it was because there was no exchange. There was no way to clear a transaction of trading land. Like if I wanted to trade my land for your land or trade this, like there just wasn't liquidity, there wasn't market makers for this, there wasn't exchanges for that. So the logical way of like, this thing is worth something, but I don't know how to value it, and it's extremely illiquid. And there are even some rules limiting that too. Like I forget the name of the form of law, but law where land had to stay in a family and
Hmm.
would be bequeathed to the oldest son. So there were even legal constraints like disallowing you from transferring that asset. So logically, how you quantify that is by the dividend stream, right? The amount it generates. And then we got the standardization of the joint stock company, which is really just, that's what stock is, a joint stock company, joint stock. Standardization and how assets and exchanges and how they can be cleared, and also standardization in accounting practices and regulate, like enforcing transparency on how things are structured, how clarify this, are we punishing fraud, making people feel more and more comfortable, you could say, with abstractions. So I didn't need to have, I'm not measuring my net worth in grain and the actual things you're giving me, because again, that's kind of almost what a low trust society or a low trust transaction needs to see. Like, show me the money, because I don't know. I'm not saying I disbelieve you, but I don't necessarily believe you. You're not my friend. There's no one enforcing certain standards on you. But I know money when I see it. I know gold when I see it. So that's why I'm valuing that so much. Like, and this is something you see in crypto too. Like, we call this real yield or fee switch in crypto. It's just a dividend. Um, it's something of a heuristic for avoiding scams or demonstrating that the business is viable. If you can pay me a cash flow for it, it's a hard, you can't hide it kind of thing that demonstrates viability and positive cash flows. Kind of the same heuristic back then, because there's not this uniform, more trustworthy way to go about uh, figuring out what an asset is worth. So regulations and accounting practices and standards played a big role in that. There were a lot of ones that developed in the 1700s, 1800s, and up into the SEC creation, or I forget the official name of it, 1950, the Securities Exchange Act of 1930, I believe, and 31. That all builds up into making this formally, like, show me the money, concrete type thing, into I'm comfortable with this abstraction that is just an on paper representation of what this thing is worth, it's still based on the cash flows it generates. Those cash flows still matter, but now it's valued in terms of what we call like a long duration asset. They're based off like looking into the future of what that will generate back to today. And that's what the essence of the discounted cash flow model is understanding that the the security and higher trust that certain regulations and standards and exchanges and the free flow of information and capital brought about made people more and more okay with that. And if I can transfer my land to someone else, well, now I actually want to value the land on an absolute basis. Now my net worth is worth that capital gain. Now I'm like, okay, wait, this became very real now, because now it's liquid. When something becomes liquid and I can get out of it much more readily, becomes much more real, and I become much more respecting of the raw value of it than the dividend stream. Um, so that's a societal based evolution. I'll stop there before I give the company based one. Did any questions on that? Did that make sense?
Yeah, that makes sense. I suppose, do you think that as it became more liquid, the mindset surrounding what mattered changed with it? Because to me, it seems weird that, particularly for the people who owned a large amount of these capital assets, say a aristocrat or gentleman, or in America, one of the big capitalists who cashed out, like Carnegie, the the capital asset value kind of matters, but really it's the ability to live that life of leisure and kind of gentlemanly activity that matters, and that's enabled by an income stream rather than the nominal value of an asset. But at least to me, because you don't have to sell it down, it just kind of exists in perpetuity without you having to get rid of the asset.
Yeah, yeah.
That kind of seems like it's gone away, even as those people still existed. Do you think that just because it became liquid, they stopped caring about it, or do you think it was their declining fortunes that made it no longer matter? From the societal angle, what would you say is the reason why that focus on income disappeared? If I don't know if that makes
So
sense.
no, it does. It does make sense. The liquidity characteristics certainly matter. The enforceability and standardization of contracts, even certain property rights, recognizing the transfer of these things, it being definitively yours. All of this kind of feeds into, and this is, I'm going to do an essay that kind of codifies this too. So it's more of a concrete kind of timeline. But it all feeds into this evolution to where you are more comfortable with an abstraction, and the abstraction is not even an abstraction so much. It's very real. You can sell out of this thing and someone will pay you cold hard cash for it. So that's not, we're not in the domain of theory anymore. And in terms of like the wealthy being able to live a certain lifestyle, like, yeah, you can't live off just a net worth figure. I mean, they have a lot of creative, like one, these guys still typically make plenty of money to like actually subsidize
Right.
their living. And if they want to like liquidate holdings to fund something, it's very, very common that they just borrow against it
Hmm.
and they don't sell it. So you're extremely liquid if there's someone willing to use that stock as collateral and you don't even have to sell it. And so you can maintain your price exposure. Now that cuts both ways. If the stock goes down, you might get a margin call. But that's an extremely common way that the wealthy sort of fund their mode of being. Carl Icahn uh, does it like extremely so, just borrows against his company stock like all day long. And I'm not saying it's like it's negative or putting painting it pejoratively. It's just it's a thing you do, and no one's forcing it upon anyone to give them that loan. By the way, no, like there's no government subsidized stock loans. Like these are banks willing to provide a loan. So it's a very free, open market decision based off one counterparty and another one saying, "Hey, yeah, I'll lend you against that. You owe me some interest, and there you go." So that's kind of how they fund it nominally, I'd say. And Now to go to the evolution on the company based side, which is a bit more of my focus with the thing I'm building called Salutary, and sort of the thing that made me really start to examine this more closely. And I think the history is kind of fun here too. So we got the societal answer of why people used to just quantify their net worth in their dividends and their income, right? Then they really did quantify it that way. It's like the amount you made per year was how wealthy you are, not capital gains. Companies meeting the culture of the time were paying out everything they earned as a dividend. It also didn't make a lot of sense for them to retain their earnings. So, meaning if I'm a railroad company and I need raise a bunch of capital to make a railroad, I make that railroad. There we go. I'm making money. What I did is I typically paid almost all of that out, all of it, because like the retained earnings I have, meaning just the net income at the end of the day, doesn't do that much for me because I'm a railroad company. I need big slugs of capital at once. I need investors to give me a lot of money at once to reinvest. Same thing with like factories and stuff like that. Like the voyages from East West India, great example, big chunk of money needed. But even, and this goes into like the core theme here, even pre electricity, factories had to be built out like one big factory at a time. And it was because of actually how they were powered. They were originally powered with like a shaft that went into the factory and then like went up, like it was a high rise type thing. And it was had to be near like a river or
Hmm.
some sort of coal. And it would power the turner and it would move this thing and there'd be pulleys and whatever in the factory. And that's how you power a factory pre electricity. Now, that seems almost kind of like why does this matter in relation to like dividend history here? It means to a company it needed to invest a lot of money at once. It couldn't incrementally invest those retained earnings and build up a whole factory all at once. It can't just expand the factory a little bit because the factory itself is built entirely around this very primitive way of powering it. as things like electricity came to be, they could incrementally reinvest more. So they could expand the factory by 5, 10%. They could take that money and invest it in their growth more. So then the companies were like, well, I don't want to pay this up necessarily. I want to keep this for myself. I'm growing. And investors didn't object over that. There was no like, up in arms, like, hey, no, where are dividends? There became almost this implicit understanding where of like, okay, I have equity in something. And if the business is getting bigger disproportionate to the dividends it's paying out, meaning the capital is worth more in their hands than it is in mine,
Mhm.
they're able to reinvest this money at a productive rate, the business improves. And then my equity goes up. So I'm okay with that. That just kind of happened. And it made sense from a company standpoint because of technology. And even now today, with like cloud computing being a beautiful example of this, a company can, doesn't need to buy servers, doesn't need to do anything. It can stand itself up with an AWS account and has unlimited scalable compute.
Mhm.
That's a really big deal. That means every little dollar I have, 10,000, 50,000, I can still invest in my growth, right? I don't need like $1 billion at once or whatever to invest. So keeping that money made more sense for the company based off technology developments. And that's where this evolution from equity, from like this junk bond abstraction into equity as like an ownership thing, became just the norm. And you see companies paying out their retained earnings lower and lower and lower over time. And it was basically because of this technological development. So tying in these two theses, one, societal and regulatory and exchanges and accounting things grew to more prominence that made us more trusting in certain things and made them more liquid, made assets more liquid to get in and out of. And then the companies, from a technological standpoint, made more sense for them to keep their earnings and they didn't want to pay it out. So we just
Mhm.
converge on this notion of like now equity, capital gains are the thing because that gets valued the highest. And technology means companies can invest it in their growth better. And that's kind of where we are today. So
Do you think, and I didn't put this in the question sheet we were talking about, so it's just something that came up when you were talking about it. Do you think that the kind of adoption of fiat currency affected this at all, where growth is now a requirement for companies if they're going to keep pace because their actual earnings are devalued every year, versus, before World War One with the gold standard, at least between Napoleon and 1914, things were relatively stable, where even if companies grew or didn't grow, their earnings were worth about the same amount in 1870 as they had been in 1820. Or if they did pay out their earnings, it didn't matter as much. Growth wasn't required. Do you think that's affected this at all, or is it these other changes you've been talking about?
yeah, I mean, probably not. Like I don't like all fiat is just simply a more standardized, convenient means of exchange that does slowly erode. But I mean, whether or not it's eroding or not eroding, you still want more of it, right? Like
Right.
even if it was a true like never going down dollar, which would have possible issues with like deflation because you don't want to spend it as readily.
Right.
But in either domain, I want right? Like, and,
Right.
and companies should act in their own best interest. And that's what capitalism fundamentally is, which I think is a misnomer. It's just the natural state of man when allowed to act freely. They capitalism. It's just human natural state. And so the nature of that, I wrote an essay called that too. I think capitalism should just be called human natural state. It's just an emergent phenomenon of how we behave. And corporations are no different. They're just collectives of humans. And I think they will always try to amass more resources and act in their best interests. And so, not necessarily. I think actually fiat probably just streamlines some stuff for them. It makes it a little easier. It makes transferring the money and moving it around the banking system and the fluidity of it a little easier. You could do that with gold nominally. It would just be claims on gold. And then people would probably just rehypothecate that gold and you would still end up getting like it wouldn't be backed by gold anymore. Like the gold standard ended far before 1971. Like the 1971 thing with Nixon is just a formality. Like the Eurodollar market and everything had proliferated in the early 50s, arguably even the late 40s, meaning there were way more dollars out there than the claims against gold they provided. And that was just an emergent phenomenon. That wasn't like a country deciding to do that. That was literally the banking system by virtue of demand for
Hmm.
growth and moving capital around just did it. So anyway, yeah, I hope that made sense.
Yes.
Is my
Yeah.
answer.
And so also one thing I've struggled to answer when talking about this privately is what exactly you're buying when you're buying an equity that either issues a very nominal dividend or doesn't issue one at all. Because if you're buying a cash flow generated in the future, as I've kind of talked about some earlier in this, that makes sense to me because it's perpetual, at least theoretically, and you can rely on it. Whereas if you're just buying something that you hope goes up, to me, that seems like speculation, no different than tulip bulbs or gold or Bitcoin or whatever, where you think it might go up and you might have an educated reason for that, but you're still not really getting anything out of it other than the hope in the nominal value of it going up. In one of your essays, you mentioned governance and voting rights being an issue people prefer equities. But then also there are ones like Volkswagen and Google that sell stocks. I think other companies do, but those are two that come to mind that sell stocks specifically without voting rights. And it trades at a very slight discount, if anything. So could you talk about the governance issue and what it is you're buying when you're buying an equity without expectation of cash return from it and dividends or special
Yeah.
dividends or whatever?
Yeah, that's a great question. And that is like the kind of first principles thought that underpin the initial essay called Governance Tokens, Tech Stocks, Dividends and Utility.
Mhm.
And so, yeah, like then the next question you have to ask is one, if there is no cash being returned to me, what do I own? Like, where does equity ever manifest? Like, what does that mean? Like, okay, I know
Right.
the academic answer. Well, you own a share percent of the company. I'm like, okay, but like, what next? Like, what can I do with this thing? Why does this stock track this company like a derivative? A stock is a derivative of a company fundamentally. The question is, why is that a derivative of that company? It must exercise or do something. And it doesn't really pay dividends anymore. Half the NASDAQ doesn't pay dividends anymore. Berkshire Hathaway has never paid a dividend. Typically, companies only pay dividends because their growth is slowing. And it's not because they have to, it's because they're trying to entice investment still. If you notice, like tobacco companies, which have negative
Right.
growth, pay the biggest dividend because why else do I want to own that thing, right? Walmart pays a dividend because it's just a GDP growing now. So there's no law telling any company they have to do that, none whatsoever. And the notion that like Nvidia is valued at $3 trillion because people are expecting that some discount of all the cash flows that company generates, discounted back to the day to be paid out to them, is a deeply academic, nonsensical answer to me. That will everyone listening to this podcast will be long dead before that ever happens. It is a complete abstraction
Right.
in a way that's like is disorienting when you really think about it. Amazon at $2.5 trillion because of expected dividend payments. That's clearly not true. It's just not true anymore. I
Mhm.
think equities have evolved substantially over the years, and no one has updated their priors on this. Like because it's like the most obvious asset class, so you don't ask about it. It's like the
Right.
thing hiding in plain sight. So like we're not curious about it because it's stock. Who questions what that is? Just read the finance book and you're done. But when you really distill down the dividend history thing and how this isn't happening, you're like, well, what am I owning here? Because if you own a stock and you want to go to the investor relations company of that stock and you say, hey, I'd like a cash flow, please. They're gonna laugh at you. Like, no, like, okay, well, can I lay claim to any of the company's resources? I have this NVIDIA stock. Can I get some GPUs for it? No. I
Uh-huh.
can vote with it though, right? You can just vote with these things. And as you mentioned, there are even some that really you can vote, but the voting is very diluted. Or some of them are non-voting stocks, like Google is a great example. Meta and Facebook is another great example with Zuckerberg.
Mhm.
He's effectively a king. Like you
Right.
can't the stock can't get him out of there. But like most stocks, generally speaking, really do when you are extremely literal about this, with no abstractions, pure praxis. It's just a vote. And a reason why I emphasize tech stocks in the essay I did is because tech stocks also have, by and large, what's called no book value. And book value simply means like the concrete stuff you could sell if you had to. So if I was going into bankruptcy as a company, my book value becomes very concrete at that point because now I'm selling stuff off to pay off my debt holders and my shareholders, right?
Mhm.
So the book value is like what can I get for what I have and like if I needed to sell like concrete stuff. Tech stocks are like all what's called intangibles, like IP, marketing, branding. They do
Mhm.
what's called investing through the income statement, which is known as like investing in your growth by hiring people, by doing certain things to differentiate yourself, but it's not a factory on your balance sheet. You don't have anything to sell. You can't like you don't sell your goodwill or your IP. Like it's not worth
Right.
anything. You can't transfer that to someone else, right? And that's what these tech companies have. So they don't have book value. I can't lay claim. And as a stockholder, you're a junior claim in the capital stack. You're the last to get paid in bankruptcy. So, and there's no book value. So you're getting nothing. You're getting nothing. Not as if you buy that thing anyway, assuming it's going bankrupt to begin with. But like
Right.
I'm trying to do every single scenario where you might get something reasonably as an investor of a tech company. It doesn't exist. Like you're not getting anything concrete from that, whether you hold this thing because you hold it and you're hoping to get a dividend, maybe way down the line. There's no guarantees. They don't have to pay it out. And even in like bankruptcy, it's still nothing. So then we're being literal, like, what does this do? I think this is the essence of salutary. And I haven't released the white paper yet, but if you're listening and you got this far, you're going to hear the white paper now. I have two letters of intent I'm committed to sign from DeFi projects I'm working with. It is, I think all they are means to facilitate changes in control, means to facilitate acquisitions, something to give Carl, and I was, in my writing, I was like, what's the difference between a governance token and a tech stock? Like, there's no difference then. These DeFi governance tokens, they just let you vote. Well, that's all stock does too. So I was thinking about like, what is the difference between these two things? Like, there's no difference. And I was on a walk in Rome, and then I realized, Carl Icahn would disagree with me. He would be like, I think there's a difference. I can do something with that stock. It has teeth. Private equity firm would disagree with me. And that's when I realized like that is the only difference. That's the only real difference. I think these things fundamentally are a means to facilitate changes of control. And so I am isolating just that and applying it to tokens. And if a token or an asset, if one asset can acquire another asset, the acquiring asset must necessarily track the acquiring asset's value fundamentals. It has to. If it
Mhm.
doesn't, that's called an arbitrage opportunity. And whales can step in and fix that. But there's no way reason anything that's trading for that has $1 of value should be trading for 70 cents. And if the
Mhm.
vehicle that can acquire it is trading for 70 cents, it should draw to parity with the dollar. So I'm doing something that institutes this in a creative way that does not make the token a security, because that's an important designation, because that's a legal one that needs to be considered and avoided, but making them vehicles for changes of control, which is what I think stocks are. So to answer your question directly, you
Mhm.
are buying the ability to control a productive asset, but it only matters at a certain threshold because you and me don't have enough money to
Yeah.
exert any influence. But private equity firms, Carl Icahn, these big boys do, and they're the ones that keep it in check. The high frequency trading firms, all the big guys with capital, they keep that thing armed because if it doesn't, then a private equity firm, then Tom Bravo steps in. He's like, shit, I'll take this. I'll take it out. I'll do what I want and I'll sell it later for more money. Someone will arbitrage that. I think that's all stocks are. And I think not a single person has ever addressed them on just those terms. And I know this because I've even looked into it, like research wise, to see if there's any research on this. There's not. There's only some academic research that tries to quantify what like voting is worth,
Mhm.
and it's very squishy. It's very very hard to isolate and measure. So it's not something anyone's ever approached from this lens that I'm describing to you right now. So yeah, I'll stop there. That's the essence of Salutary. It's an M&A vehicle that imposes value accrual on tokens based off of my rather unique, unusual, but extremely literal understanding of what all stocks do today.
One thing that's really interesting because it leads into what I wanted to ask next, which is this governance issue. Because one thing, and I talked about this in a couple interviews now, is the abstractions with which we hold assets really make it where it's impossible to affect real world outcomes through them in most cases. And to go back to the Pride and Prejudice example, Mr. Darcy or those like the Dukes of Westminster are lords over their estates where they can determine what happens. If there's going to be a brewery, if there's going to be a distillery, or in the case of the Dukes of Westminster, what Mayfair and Belgravia, these very valuable, huge parts of London, are going to look like. Just even at the ground level, what type of colors and stonework are going to be used in these buildings. That's different than how most people hold companies, whether it's kind of indirectly through a trust with trustees or more likely through ETF vehicles. So if you have $9 billion in NASDAQ, what can you really, or, QQQ, what can you really accomplish with that? What in terms of power or loyalty can you affect? So I guess this has two parts based on what you just said. One, do you think that's kind of an inaccurate framing and the people who matter still can affect things through these stocks or governance tokens? And then also, do you think that the attempt to separate wealth and ownership of assets from the ability to affect things in the real world, particularly power, determining how things go, do you think that was intentional or just happenstance that coincided with kind of differing views of wealth and equity and what it's for?
That's a good question. And before I answer that, actually, I also want to tout one of the projects that's working with Salutary with me, Amplified. I wanted to give them a shout out for being extremely forward-looking and pioneering group of guys. You should check them out in addition to Salutary if you're in DeFi space. Anyway, now to answer your question on, I mean, if you own an asset, like we'll say Bezos and Amazon, Elon and all of his companies, like he's a king when it comes to
Hmm.
those things. Like truly, if you look at like there's a lot of anecdotes on this on Bezos. Like he is a tyrant, completely determines and dictates everything that gets done there. A lot of it's kind of bizarre and, well, I mean, bizarre to the unassuming, and then it ends up working, right? Like he obviously knows what he's doing. But you have full, exertion over your assets in the US anyway, for the most part. Like, in France or other places, there are limitations on like labor or, labor rights that are so strong, they're probably become prohibitive for hiring growth because like you can't fire someone or you can't make certain changes. But by and large, so long as you're not violating like a US orthodoxy, policy of like diversity and inclusion, you can do whatever you want with your asset, and how you hire and manage that asset. And then you see a lot of these guys once they become wealthy. Elon's a good example of this, and Carl Icahn had drawn him again. If you walk around Manhattan, you're going to see a lot of Icahn medical schools, like Icahn. This is us. Like, and I looked at, I was like, oh, that's the Icahn Carl Icahn. That's how rich guys then spend exorbitant amounts of money, is influence. Ackman does this all the time. You'll notice rich guys become altruistic and giving away money and donating for the cause. Maybe they do have some sense of like wanting to return to the world, but I'm sorry, like these guys are killers. They're
Mhm.
type A's. They're viciously smart. They're viciously vicious. And like they want to expand their reach and power and control and money. And the way you do that is to start accruing capital in the political realm, not the financial realm. And so I see what they do. I see what Elon has done with like basically having, he's in the Trump administration now without getting a single vote for himself. He has bought real political power insofar as the executive branch has political power. But so these guys are still exerting control, maybe not through like as explicit means as like if you're a lord over a swath of land and you can just tell people what goes on there. Like, yeah, there's more like public property that's government owned where you can't just put a bill, a statue up in your likeness. But these guys work around those rules, and I would say, every MBA school you see with a guy's name on the front of it is from a huge donation he put on there, so you
Mhm.
see his name every time. David Tepper and Carnegie Mellon's MBA school. There's a lot of MBA schools named with a name on it. Look at where they came from. They donate a lot of money to do that. So these guys, they're still doing stuff. Like money still definitely buys power. I would say money and power, money exerted correctly. I mean, correctly, if that's your goal, should probably almost be synonymous with power if you're a good allocator of it. The same way, if you're a good capital allocator, you should be getting good returns. If you're a good political capital allocator, you should be gaining more power. And if that's your objective, and these type A guys, once they've reached the summit, they tend to be like, well, what's next? Well, what's next is really, really exerting influence. So I think that still happens just in different ways, and it manifests visually a little differently.
Okay, that makes sense. I guess one example when you're talking that come to mind is, instead of just having his tenants or telling them how to vote, Zuckerberg donated like $400 million or whatever it was to election security to have them go round up votes in the projects, which I guess
Yeah,
ends up being similar in practice if hidden behind
absolutely.
some
And
abstractions.
and
So,
that money shows up too when he can talk with the DOJ or people in the
yeah.
administration. Like they know he's a big donor, right? That's a great example. I totally forgot about political donations. Absolutely a way for like modern day influence to do stuff like that. So yeah,
Okay, that makes sense. Uh, so another thing that comes to mind when you're talking about capital gains versus return of capital via dividends is the permanence of it and the sort of like stability and world that creates. To me, looking at it, one in which the holders of capital are generally assured that like their grandchildren are going to be getting the same income adjusted for inflation from the same land that their grandfathers did. That encourages kind of stability and reinvestment in that property just to keep it what it is and keep the ties that binds to this given asset. And since you don't have to sell it, that can be built up over generations and really become something different and it become great over time. Whereas on the other side, if it's a capital asset appreciation society, one where say you hope Palantir goes from 20 to 70 like it has in the past couple months, at the end of the day, unless it's large enough where you can take out a loan, you have to sell it. And even in the loan situation, you have to sell it upon death to pay back the loan generally. And to me, that looks like it would constantly erode these kind of ties to tradition and stability and create a very different world. So I guess because you have to sell the asset to get income from it at some point, it goes away. So do you think that's accurate in that it creates a more impermanent world and one without these kind of ties, tradition, and uh, old heritage that existed? Or do you think that it's uh, a better one and that the constant turnover creates this need to create new things that's more conducive to human flourishing? I know that was a wordy
that's
question, but
no, that's a really good question though. It's a collective act. it's a collective action question. It's a question of fundamentally like values, and it's a political question. And it's one that I think is answered correctly. If there's not a correct answer, it's answered correctly by virtue of the people expressing the kind of society they want to exist within. And, as with all things in life, there are trade-offs. Every good thing comes with some sort of sacrifice or some sort of possible negative externality that wasn't there before. That's just a canon of nature and just existence. So if you make, and by the way, the only way to maintain that, what you just said, is if you have the state enforcing it.
Hmm.
And they used to do that.
Yeah.
This like British law used to impose that, like it has to be passed on to the oldest son, things like that. So, one, you need a government literally to tell you to do that, because if not, then it's up to the guy who owns it, right? And some guys sell. And then you're saying, well, you shouldn't have the right to do that. Like, as a collective action question, we think if we force it to stay in your family, it will be taken better care of. I mean, I do think things that are family heirlooms, sort of family business heirlooms that stay in the family longer, willingly probably are. I think if it's just like this perfunctory thing that, okay, well, your dad owned a shoe business in this plot of land, so now you do too, and that's what you do. It's very pigeonholing.
Hmm.
It's one of those things where you have to do the family business, and if you don't, is that illegal? Like, how does the asset get managed? Like, then I just have this burden I have to deal with if I don't want to maintain that. So there are a lot of assumptions baked into that. That one, everyone would want that, and that the negative externalities of like forcing oldest sons to like stay in businesses that would probably increasingly be more and more old economy businesses. Unless you want to say, I don't know if Jeff Bezos has any kids, honestly, but like Amazon has to be bequeathed to his son, like that would be the modern day version of that. Like Warren Buffett would have to bequeath
Right.
Berkshire to his oldest son. Um, that feels strange on the surface of it, but like it definitely has some parasitic, more scalping kind of externalities to it, where it's like, well, all right, now I'm just going to dump in and move along, and it creates less permanence, like you mentioned, to the asset itself, but it also probably puts the asset fundamentally in the hands that are most capable to maximizing its value. And maximizing its value should not be a dirty word, because if you maximize the value of an asset, that should mean you're maximizing its cash flows. And if you're maximizing its cash flows, that means you are maximizing the value you're providing to other people, because you can't get those cash flows without them willingly paying you for that service. So there's some nobility in that. Like, the only way that I am increasing the value of this company, and this kind of draws in, by the way, why I call the company I'm building salutary. It's just a fancy word for healthy. When you
Hmm.
align incentives for productive purposes and make people both focus on value creation and doing things, they get richer by behaving correctly. That is a positive aligned incentive. That's salutary. That's healthy. So, um, you know, I don't think there are that many negatives to doing that, though there definitely are some. I think it probably puts capital and assets in their most productive use cases. And it probably collectively maximizes the value best for everybody, in terms of businesses that should flourish will flourish, and businesses that should probably be parted off and sold
Hmm.
probably should, because they're probably getting old, not doing as well, being mismanaged. Private equity exists for a reason. There are a lot of negatives to private equity, but like a lot of things it does, though, is restructure the company and make it valuable or viable. So I think, as a general rule of thumb, allowing a complex adaptive system, which is the economy, which is emergent human behavior, which is what we do as a collective, as a society, allowing a complex adaptive system to allocate resources most productively and freely. Generally speaking, it has some downsides, obviously, but broadly speaking, is definitely the most positive way to do things. Because to not do that would necessarily require an external force, a government. It has to be a state or a mafia, which is same thing but worse, or the same thing. If it's a mafia and a state would require an external party saying you can't do that. You can't sell that thing that you own. It must stay there, and he must work it. I Yeah, that seems worse to me, because that's a much more difficult thing to impose. Though I'm very sympathetic to the romantic feeling of a lot of those of that. It sounds better. It does sound nicer. And no one's forcing you to sell, right? Like, you keep it in the family if you'd like. Like, no one's I think anything that I think in any kind of legal rulings or proceedings, we should definitely defer to like the lineage of the company and the ownership. If there's any kind of legal skirmish or problem of like, oh, I'm not sure how that would manifest, but I think there should be some
Hmm.
deference there to the familial structure and the family that owns it, certainly. And I think even codifying that would probably be healthy. If they're fighting to keep it, they should be able to keep it. But if they want to sell it, then they probably should be able to sell
Okay. And just since we're talking about capital assets, one thing, or stock particularly, one thing that often comes up is the critique of the current governing system for stocks, the boards and the CEOs caring much more about quarterly earnings than the long-term health of the company. You see
it.
this a lot. It was one of the critiques of that insurance CEO who was just shot. But the not to get into that, but the caring about like quarterly earnings is very different than some other things. This is one, I think it was
Yeah.
The Guardian ran an article on the trust that manages the Duke of Westminster's assets. And it's just a good example because it comes up with this kind of old world thing where since it's so large and it's pretty permanent wealth, they're willing to spend more on building things that are going to last a lot longer than, say, the private equity firm building the 4/1 wooden apartment buildings with like the bad burger
Yeah, yeah,
joint
yeah,
underneath. The, or,
yeah.
that sort of thing. Do you think that's kind of accurate and that critique is accurate, or do you think there are other things that have led to this kind of short-termism, or to use the crypto term, high time preference
High time preference.
thinking
Yeah.
amongst corporate executives?
Yeah, and that's an excellent point. Like, there are some, yeah, the near termism definitely does not foster necessarily the most positive long-term behaviors, especially when you have like the moral hazard of executives that can get paid for extractive behaviors that are not accretive to the company. A prime example of this was Citibank in the financial crisis. There's a well-known event called the Bob Rubin trade. Bob Rubin is a former Treasury Secretary. He worked for Citibank, and because if you ever work in a political administration, once you leave, the private sector just falls over trying to hire you because your name just looks so lovely on their
Mm,
website. I mean, that's basically it. Um, and he, in addition to the board, made a series of horrendous decisions regarding Citi's decisions with derivatives. Now, Bob Rubin got paid a lot of money, like I think a couple $100 million, something like that, over his tenure there. Citi basically died. Citi did die. Citi got a loan, and it's viable now. But like, if there was no backstopping of that, it would have died. And Bob Rubin got to keep every penny of everything he was paid out, all of it. Now that's
mm,
not specific to him. No executive, I shouldn't say no. Maybe there have been some clawbacks, but they're not like a standard thing. No one's going back 5 years ago and be like, okay, you have a loan, you have a debt now because
mm,
your decisions, you got paid for decisions at the time that you didn't have skin in the game on, and now that thing died. Now you owe your money back. That's a huge problem. I have written essays on this in a past life on more formal publications on there should be like multi-year look back clawbacks. There should be ways of like literally like you better be making good decisions because if you're not, you're losing that money. And if you can't pay it back because you spent it, well, we have a lien on your assets in your home. That kind of stuff. Like you need more, there needs to be less moral hazard with executive decisions because once they get paid, it's theirs and they're gone. And so you can get a lot of this quarterly thinking that you're describing here, where they do things that are maximally capital efficient, air quotes there, near term to increase stock value near term. But it could settle it with debt. It could settle it with things that inherently increase the risk of it. That does not make the business viable long term. There needs to be more ways to manage that. Like I'm not like one of those guys that freaks out about certain bailouts or what have you. Frankly, the government made a lot of money from the bailouts it made in 2008, like a lot. No taxpayers didn't lose anything in the 2008 bailouts. But what I am actually more angry about it, what I focus on more is executive punishments for that. The ones who actually caused it. Because the government didn't really cause that. There are some regulatory things you can blame on them, but it was private sector. Like the private sector got too nuts. It was very opaque and making tons of loans that were extremely frivolous and off no assets, the ninja
mm,
loans of '08, and they imploded on themselves. That's not a public sector flaw. That's a natural state of an emergent phenomenon in the complex adaptive system. It gets ahead of itself and fucks up sometimes.
mm,
But I think the people who were overseeing that fuck up should have to pay something and should have a lot of punishments and some sort of hazard or um, a moral hazard imposed on them through clawbacks. So I think that will fix a lot of what you just described with the near-termism, a lot of it. I really think it would because there's a great Charlie Munger quote: "Show me the incentives, I'll show you the outcome." If you
mm,
change those incentive structures, I promise you'll change the outcome of that stuff. You see it a lot with Japanese companies too, by the way, that don't operate so what's called last minute inventory, like so low
mm.
margins, where if anything goes wrong, it's like, oh my God, like we need a loan.
Right.
Like Japanese companies are very actually stable from that lens. Japan hasn't grown in like a very, very long time, mind you, but like there's the trade-off for that is they're stable.
Mm,
So the Japanese culture is much different than that. Another way you could ameliorate this is if you change the way certain things were reported. Say companies didn't report quarterly earnings, say they reported semi-annual earnings. You could also change this by way of virtue of how the executive is paid. It could be a mean of cash flow improvements over 5 years, not like hitting this number by this date.
Right.
That's silly. That makes me gamify a number for a date, and I don't
Yeah.
care how I get the number on the date. That it's just garbage. Like it's just not any. I don't think anyone who knew they'd have to have a consequence 5 years after that would want that pay structure. I don't think a board that was really in the long term thinking of the company would set up a pay structure that way ever too. I think they would do like median averages of certain metrics that are directly aligned with positive things you want the company to do, cash flows and other sort of deliverables. Then you could also fix that. So you need to change the way basically executives are paid,
Mhm.
the way incentives are aligned, the way possibly the way earnings are even reported. You might even change that to semi-annual because now I'm calibrated more for every 6 months and every 3 months. That makes a difference.
Mhm.
And then you need to impose some kind of moral hazard repercussions for executives with their golden parachutes and their massive options. If you do something that nukes your company, Bob Rubin should be like in a type of debt that's passed on to his kids. Like it should be that serious. Like if you impose that kind of cost in society and you got paid that much, you have to pay it back. There's nothing unfair about that at all to me. It makes you responsible for your decisions. So yeah, I think structuring that on the private side is how you do it, and the public side regulations can do some good there maybe, and making the incentives line in a salutary way
Mhm.
that focuses behavior on outcomes that make you have a long mid to long term mindset
Mhm.
from that.
And this is somewhat unrelated, but you mentioned Japan, so it made me think of it. One also frequent critique, in addition to the quarterly earnings issue with capital asset appreciation focus, is that it essentially requires infinite growth, at least in some respects. You could probably get around that with saying some are destroyed, some are built, but assuming creative destruction is somewhat limited by the state and just continuance, it requires infinite growth for it to keep going up and you to keep making something off of it. Whereas this older world society where population was pretty stable, et cetera, if you were making, say, 20 pounds from some given asset every year, that was worth something and could continue indefinitely because it wasn't required to grow to be worth that amount. It could be stable and that worked. Whereas if you're counting on it to continue growing, that requires infinite growth of some sort, which probably won't come with population growth unless it's just nominal and it's because of inflation, which is
Yeah,
less
yeah.
helpful. Do you think that there's a way around that? Is that seeing the issue poorly, or do you think that inability to have infinite growth might lead to some focus on return of capital to shareholders via dividends or some other instrument?
Yeah, that's a good question. And I write some critiques and breakdowns of that mindset in two essays on my Substack and on Twitter called Mid-Range Jumpers for the Middle Class
Hmm.
and Touching Soul, Touching Senses. And it is a very, it's, I don't want to call it a globalism critique because that makes it sound trite. It's a very unusual breakdown of exactly the externalities and problems that this mindset has writ large when everyone behaves this way. It creates a lot of power log streams. It eviscerates the middle.
Hmm.
It eviscerates the middle no matter the domain. I call it mid-range jumpers for the middle class because Moneyball and globalism are fundamentally similar phenomena. They're similar. They're basically identical game theoretic strategies where you maximize certain behaviors based off expected value thinking,
Hmm.
and based off places where you can maximize the output and expected value thinking. It's spreadsheet thinking. I call it spreadsheet brain. And the externality of both of those is you eviscerate the middle. The mid-range jumper in the NBA is like non-existent. I throw up a shot chart in my essay. It's like there's no mid. The mid-range jump shot is like gone because you either shoot a three-pointer or you shoot a post shot. Same thing with globalism and middle class. We all know what happens there. What's happened there? It's
Hmm.
empirically the case. So these expected value maximizing behaviors nuke variance, then they enhance fragility because of that, because now everyone's clustering. It makes a lot of clustering effects. Everyone clusters in the same strategies because they are game theoretically like the dominant near-term ones. And it just produces a lot of problems. Um, now, to your question directly, which that was a bit of a tangent to your question, sorry. Like, do we return more to, say, the cash flow mindset, the dividend mindset versus the abstraction of the equity thing? That was fundamentally it, right? Like, are
Yes.
we going to see like a
I guess
return to that kind of concept?
if I could just try and phrase it a little better, I know I rambled a bit, but so if you look at, say, an estate in 1820, if it produces 1,000 pounds a year, that's fine. And then similarly in 1870, if it produces 1,000 pounds a year, that's fine. It doesn't require this infinite growth to continue holding its position in society. It's kind of worth the same, more or less. It doesn't require this infinite growth. Whereas now, if Palantir is worth $70 today and in 10 years is worth $70, people are going to be very upset about that, even
Right,
if
right.
it's done acquisition, just however they do it. And so in some of these companies that are declining, whether because of population loss, like in Japan or in America, people not smoking, you've seen, as you mentioned, this larger dividends amongst the like tobacco companies because people aren't using the products as much. They're returning it that way. Do you think that that's a trend that will happen, or is there some other way around the infinite growth problem for equities and other capital assets?
Um, I don't think the infinite growth mindset is a pernicious one on the company level. I do
Hmm.
think it's a deeply toxic one at the national societal level
Okay.
to only calibrate yourself. So I have two different answers to that. On the corporate and company level, I think it's fine.
Okay.
I think the company should be constantly competing and jostling with each other to undermine, compete, work against their competitors to improve their product and sell it for less and give us more.
Hmm.
That's when human natural state capitalism is allowed to do its thing. That should be what naturally gestates. The only thing you have to be careful of is if you let that fully flourish, then you get monopolies and extreme power laws, and that's not good either. So there needs to be a hedge on that.
Hmm.
But on the corporate level, like I just don't think that's a problem. They should be doing that, and just because capital flows to its most productive use cases. And if you want your stock to go up, it should be gaining in value. It should be improving. It should be increasing its cash flows in both currently or in the future based off of your how you're structuring yourself. And if you are a fast grower, you should be losing money. And when I say losing money, I mean your net income is negative. We
Hmm.
fully expect you to lose money, but that's good because you're gaining market share. Because in the future, that loss of money now produces much more money in the future with the market share you have. That's why you see all tech companies lose money for a very long time. They're not losing money really. Like they could stop their spending on marketing and certain things like right now and be profitable next quarter if they wanted to.
Right.
But if they did that, their stock would be destroyed though. Because people will be like, why? Like you're not growing anymore. I don't care about the net income number. I want you guys to grow. So
Right.
that's why they do it. It'd be very easy to reverse that though, and to stop hemorrhaging money if they wanted to. It's not like it's difficult. So on the corporate level, I think that's fine. Infinity growth, even though it's a fake metric, should be the metric. And then once you get to Walmart size, you're Walmart. Like, whatever. You're growing slowly. You're growing along with GDP is
Hmm.
basically what you're growing. Cool. And they pay like a reasonable dividend. I don't know what it is, like 3, 4%,
Right.
which is like the standard. We're a good business. We're slowly growing. Oh, hey, and here's a little extra for you. Buy your stock. And
Hmm.
then you get a lot of like the pensioners and the kind of, elder Gen X boomer type who want more stability. That's kind of your crowd there.
Hmm.
And there you go. Nothing wrong with that. The tobacco companies, because they have negative growth, or be like, please buy our stock. Here's money. That's kind of why they have to
Yeah.
do it. And the Nasdaq growers, the tech growers, are like, we're growing. We don't need to pay anything. And the investors are like, yeah, we don't want your money. The money's more valuable in Elon's hands. It's more valuable in Jensen's hands than it is ours. Please don't pay
Okay.
us a dividend. So that's good. On the national level, though, when you structure, because now we're talking about a collective action issue on the national level, and that's a value question, and that's a question of what are we orienting ourselves around. And what I write about in Touching Soul, Touching Senses is fundamentally what's a dichotomy between hedonism and eudaimonism. It's funny. I've never said that word before. Do you know the word I'm referencing?
Eudaimonia, or like the Greek state of like
Eudaimonia.
happiness through flourishing. Okay.
Correct. You
I can't
say it
pronounce
again.
it, but yes. I think it's eudaimonia.
Eudaimonia. Okay. I've
I
never
mean,
said the word
don't
the
count
right.
on me to pronounce anything other than Anglo-Saxon words, even remotely correctly. Norman
Better
is a
than
bit too
me.
much for me, but I think that's how you say it, and that's what it is.
Okay.
Eudaimonia.
And I'm Greek, so I should be able to say it. It's funny. I've written the word God knows how many times, but I don't think I've ever said it before. So, which is fundamentally a view of like, we are orienting ourselves purely for a materialistic sort of spreadsheet tier expansion. Because a lot of this GDP growth is, I don't want to call it fake, but it exists
Mhm.
only in a digital realm where like, I'm sorry, like to think you can grow forever is a false promise against scarcity. Like
Right.
it literally is a promise against scarcity if you think you can always expand in some respect. Because even if it is in the domain of bits, the digital realm instead of the physical, the atoms-based realm, yeah, if we're being really literal about it, I'm sorry, like compute still has to run on physical things. It has to run on atoms. It has to run on GPUs and hardware. It has to be powered by coal. It has to be powered by electricity,
Mhm.
by physical things. So there's still a scarcity element even to that. You can never ever escape scarcity. So like anyone who says like post scarcity luxury communism, like, and some people
Mhm.
say post scarcity seriously, by the way. Like I hear some people
Mhm.
say, well, we get to a post scarcity society. I'm sorry, that's not someone who's just thought about this very closely. That's not a serious statement because another very obvious thing that happens empirically, I think it's called Jevons paradox. There's other paradoxes for it, is when energy becomes cheaper or things become more readily accessible, people don't become placated. They use more of them. They start just, okay,
Right.
well, I'm going to gobble up more and more of this. So if energy was like free, I think that would probably be one of the most harmful things you could ever do for mankind. Like they would, it's a fake world because it would never be the case. But like,
Yeah.
I don't know, it's a fake world, so it's not worth theorizing on it because that energy has to always come from something physical, unless we become digital beings exist in a digital
Right.
world. And then the question is still, how is the electricity generated?
Right.
So anyway, because that is not a tenable concept, when your growth slows, it orients you around doing things that are sometimes pernicious to maximize that. You can see that with globalism.
Mhm.
You see that, which is an emergent phenomenon. Like that is part of capitalism. Like if countries are allowed to just, okay, like we can go wherever we want and do our thing, there are definitely some negative downsides to just uninhibited capitalism. And I think you're seeing that globalism. You're seeing that through a mindset that is fundamentally predicated on growing forever. And growing just simply means the GDP number growing up.
Mhm.
And if your North Star as a society and as a country is making a statistic go up, not even a quality of life thing, because if quality
Yeah.
of life was your statistic, we would not be doing what we're doing.
Right.
There's very vanishingly few metrics for the middle class in the vast majority of this country that shows quality of life, the purchasing power, and the well-being. There
Mhm.
are many ways to measure that are going better for people. I think it's self-evidently not the case, but the GDP is going up, right? So I think that mindset applied societally is one, it's fake. It's a fairy tale situation, and two, when you start taking it too far, you're starting to see the early impacts that we're seeing now. So that reminds me of a saying, and I'll stop here. Uh, I'm a libertarian at the federal level. I'm a conservative at the state level. I'm a liberal at the city level, and I'm a communist at the family level. Right. So like
Uh,
on the family level, again, nobody works, and I pay and support them. With a high trust society, your politics change a little bit. I'm okay with a little bit of substance. You're my king, you're my countryman. I'm not quite as fiercely libertarian at the state level. Okay, conservatism at the federal level, fuck off. You're
yeah.
totally
Uh,
libertarian, right? So like that's kind of how I would apply this here too. Like there needs to be nuance to a lot of how these things are viewed and the participant that's deploying them. For the corporate side, I think it's fine. You just put some checks and balances on them, like antitrust regulation and things like that, to keep
mhm.
the extreme power laws from going too nuts. You also do things like RFK wants to do, where you limit, say, how much high fructose corn syrup you can dump at something. You can't just package everything in the shittiest plastic you can find, right?
Uh-huh.
Because companies will do that if allowed to. Again,
Right.
they should do that if allowed to. They should act in their own self-interest. You should not ever be banking on a company just being, okay, well, we're going to be the good guy company, because someone else is going to undermine them just by virtue of
Uh-huh.
competition, take their market share. It's never going to work. You shouldn't expect them to do that for the same reason you shouldn't expect to be able to cuddle a tiger. Like it's just not his nature. But the governance of society needs to be structured understanding. We want these guys to be free and act in their self-interest, but there are some manifestations with extreme power laws or extreme, gross margin orientation, like microplastics and everything, that
Mhm.
is not good. And
Right.
that's where a healthy governance structure steps in. Like, sorry, you can't dump high fructose corn to do anything. I don't care if you have to charge a little more for it if your margins are fucked by that. Too bad. Like you just can't.
Right.
Like it's just not good. It's not salutary for society. It doesn't create a stronger populace. So anyway, I'll stop there. I hope that made sense. Any questions? No, feel free.
Yes, I won't keep banging on about this, but one more thing that came to mind, because you're describing it quite well with the companies. I think one issue is that for most people, these companies are held in total stock market indices of some sort. So whether it's like the Vanguard Total Stock Market Index or like the total US one, whatever, it's a contained universe where, say Amazon's doing well. If there's not actually infinite growth, then theoretically some other company against which it's competing is doing poorly, where the index wouldn't go up. I know that ignores private companies and everything, so all else being equal. But I would think that if you're in this world that's not actually growing, there's not like more coal coming out of the ground and there aren't more people to buy it, things don't like actually go up, which would become a problem. Although I could just be misunderstanding it. Do you think that's an issue we're going to face or not so much with this focus on
Yeah,
growth and infinite growth?
Yeah, and part of the reason why it's this, and it's tried to call it a Ponzi, but at the micro scale, we would call that a Ponzi, but at the macro scale, it's just neoliberal economics. It's just being a good Yale economist, right?
Uh-huh.
Um, yeah, it is predicated on an unsustainable practice, and that is a lot of that is drawn from how we've set up our retirement structures too. Pensions, for example, pensions need number to go up because they have liabilities, they have payments they need
Right.
to make. 401ks and people's retirement funds. Like a lot of our society and people living reasonably well post working is predicated on that number going up.
Right.
So, that I'm not saying like the motivation of, wanting the GDP number go up, because if the stock market does go up, the GDP number, like the stock market
Yes.
will roughly correlate with the country over longer periods. Over shorter periods, it will definitely fluctuate. People like to look at like the stock market's going up while COVID's going on. This is fake. It's not fake. It's a forward-looking mechanism. It looks about
Yeah.
6 months to 9 months in the future. That's what it typically does. Stock markets look about 6 to 8 months, 6 to 9 months into the future. Um, so we are going to have to reckon with that because it means we probably have been living beyond our means.
Hmm.
You kind of see that because we had a lot of fake luxury problems right now because we have luxury conditions that we probably don't fully deserve based off this number go up forever mindset that needs the stock market to go up. It needs debt to be serviced because if it doesn't, then you might have like revolution tier just unrest on your hands because
Right.
if pensions don't pay out, like what do you do?
Yeah.
That's a big deal. That's a big problem. Also, if people, start losing jobs in mass, which I feel certainly be the case in 5 to 10 years when AGI becomes much more, much more present, what do you do? Um, I think a form of that will be dealt with by having to do some kind of UBI. I think that's just an inevitability. Universal basic income, which is just a way of saying welfare that's generally not means tested, that you just get to keep everyone from being homeless. It should probably be means tested if we do it, but I also just think it will be an inevitability once, the last I heard, this was 4 or 5 years ago, the biggest occupation in the US for men is driver.
Hmm.
It would not be surprising to me if within, say, 10 years, a human driving a car is illegal because you are actually, 50 times more likely to kill somebody than the AI. Like statistically, like you're probably like the likelihood is just so much there. It's like, why are we taking that risk? And also, if companies can do it for like the power of electricity, why am I employing a person? Again, it's just a very
Right.
natural kind of development. So I don't know how to look further out to the future beyond that than to say, one, it is predicated fundamentally on a Ponzi-esque mindset that the number must always go up. And the number cannot always go up just by virtue of natural law and scarcity.
Right.
Just those are things you can't out engineer. And when that doesn't always go up, when there's a reckoning, which there will be, when pensions and 401ks have a problem, and when people cannot find work, low skilled people cannot find work, and even medium skilled people. Like, honestly, I think pharmacists and doctors and lawyers should be
Hmm.
most concerned
Right.
because their stuff exists purely in the information realm. Pharmacists, I don't even know why they only exist because of regulatory reasons at this point. Like, the computer can't do it. Um, I think you probably have to do some kind of UBI adjacent thing. But at that point, though, I don't know what that buys you. Because again, just because
Right.
you provide people dollars does not mean, again, scarcity. Just because I give you more claims on assets does not mean I create more assets. You cannot create blood from a stone. So while the U.S. is never, this is a lot of writing I do on the Fed, by the way, like on this that people listening might find interesting because it's very unorthodox and not something you probably ever heard before. And it's kind of related to this statement, but the U.S. government never has a solvency issue. It'll always be able to service its debts. It'll always be able to provide UBI. It doesn't need to raise money. Like it's not going to have like an issue with bonds. It doesn't need to even issue bonds really anymore. That's a vestigial thing from the gold standard. But that doesn't mean the dollars they provide exert the same claims on resources, and
Hmm.
that will be a problem. And yeah, I don't know how that gets addressed. That's too many emergent phenomena in the future for me to guess. But I think there's what I just described is probably inevitable, and that it's going to happen in some form. When and where is TBD. But that's kind of how to fundamentally view the shortcoming of the GDP go up forever approach and how that will impact real people in real ways when it stops working.
Got it. And to remove it from the realm of the theoretical and just back to kind of what I planned on talking about, one change that kind of coincides with this change from dividend focus to capital appreciation focus, to put it simply, is the change in politics and who ran the political system. So if you look at before World War One, typically governments, kind of with the exception of Germany, were pretty slimmed down. The English colonial office only ever had like 1,000 employees or 2,000. It's some crazy number. And if you look at why, at least in my opinion, it's that this pre-World War One gentry and aristocracy wanted to handle things and to not have to pay taxes to support a large bureaucracy. There are many, many other issues as well, but it's kind of two things I think are relevant there. And you saw it in the 1910 People's Budget fight. They just didn't want these taxes to pay for this extra stuff. But then, with the destruction of that class in World War One, inflation, all the issues, you get the separation of wealth and power to some extent, and then also this rise of this mass bureaucratic class pretty much everywhere. That now, instead of having Lord Palmerston determine what's going to happen with a staff of like 20 people or whatever it was, it's suddenly
Yeah, yeah,
15,000 people in the EPA or X
yeah,
government office deciding that you can't dig a pond in your backyard. Do you
yeah,
think that
yeah,
that
yeah.
change from kind of slimmed down aristocratic government in the US without a formal aristocracy and in Europe with formal ones to this kind of opaque bureaucratic government is at all related to this change in how wealth is viewed? Or do you think there are other issues there? And kind of what changes related to that do you see coming as wealth and our perception of it continues to change?
That's a great question. And I'm going to take you in a direction you maybe didn't expect in the answer to that. To answer simply, no, I don't think that's predicated on the stuff I just talked about.
Okay.
Maybe a little bit. But fundamentally, though, what we're talking about here is the government is spending more and more and more and growing and growing and growing to the point where it's become a massive jobs program. And so, yeah, I actually don't think that's a financial history discussion. I now am going to take this into the domain of an essay I wrote called Gain Dependence, Gain Power, which really deconstructs the inferior game theory of everyone, every vote counts the same democracy.
Hmm.
I think, and this is borne out in data and just logic, which is in my essay, that it is the dominant strategy that if you are in a democracy and it's a simple majority vote, which it basically is in the US, I mean, it's a majority vote at the state level, it's a majority
Right.
vote. Then if you have the resources to buy votes, you need to buy votes. Because if you
Hmm.
don't, then he's going to do that.
Right.
Okay. Then and this is why conservatism is this liberalism going the speed limit, right? It's all trending left, it's all swimming left. And you might have to ask yourself, why? Is it a cultural problem? Is it like, are we not writing enough based essays? Do we have like, is it
We
hip
need more
hop? Is it all
substacks.
these exactly we need more substacks, right? That'll fix it. No, and this goes back to a statement that I repeat repeatedly in a lot of essays. The environment dictates the expression, and it also dictates the dominant strategy. And if you look at the GDP share of spending of government spending as a percentage of GDP in every Western country, and this is in my essay I'm looking at actually right now, it creeps up from like under 10% or so in the 1800s. And this is the US, Sweden, the UK, Italy, France, Germany, Switzerland, Israel. So reasonably
Hmm.
good sample size there. We go from like sub 10% to the lowest one now is Switzerland at under just a little under 40%, and it used to be like 7 in the 1900s. 7% of GDP is spending to a little under 40. Um, what green line is that? France is a little under 60% of GDP. The US is right around a little under 40 after being in the early 1800s, like 3% of GDP. So we're not talking about spending increases on an absolute basis, is why I'm saying this. That's spending increase on a contextual relative basis.
Hmm.
It's adjusted for inflation and all that. Okay. Because if I just said it's spending more, but I didn't adjust the number, there's no
Right.
need. And you see this too with what you articulated, which I would say is a jobs program, which I would say is a way of buying votes, which I would also then say is a way of buying loyalty.
Hmm.
And that's what you do if you have the wealth to buy votes. You should do that because that's how you gain dependence fundamentally. Because if you are now dependent on, and not necessarily even on welfare, but if you're dependent on certain things that allow you to benefit or thrive economically, and this is a handout, this is a transfer of some way. Like this guy should be taxed higher and should go to you in some way. You deserve more, and I'm going to give it to you. That's the essence of a lot of these policies. If you distill them down just to brass tacks, you do that because why wouldn't you do that? Because I can win much more easy that way because it's extremely easy to buy votes and democracy Puritans and all these people are like no, this is just practical economics. Like It's funny how it just trends one way, though, isn't it? It's funny
Uh-huh.
how it all goes up and to the right
Yeah.
with all those spendings. It's funny how the government never shrinks, no matter who's in office.
Hmm.
And no matter who's in office, like go back and look at them. Like it's the conservatives don't do anything. And I'm not
Right.
even faulting them that they can't, that they don't. It's because they can't. They wouldn't win. They get destroyed. It's you can't campaign on high conscientious balancing the budget. Hey, we're going to give you less, but it's good for you actually. That's
Yeah.
not a message for the masses. It's just
Yeah.
not, and especially if the resources are there and the other guy's saying, "Hey, I think you deserve more." Just saying, if that's fundamentally your message,
Hmm.
that's what counts. Cthulhu swims left, no matter the situation. If you are wealthy, I think it is just my game theory breakdown here is borne out in every stat you basically want to look at over 10 to 20 year timelines. People may want to look at like smaller time frames, like, oh look, the election in 1984 where Reagan crushed it. Based, right? Things are going right wing now. 20 years later, look at you. Like,
Hmm. Yeah.
no. Brexit in 2016. The UK is not getting more. It's not going the right way. Enoch Powell, I think, had like a 70% approval rating or something, like hugely popular, hugely popular. Again, we have bursts of energy like this often within the cycle. It's not Cthulhu only swim slap. Like there are right wing pushbacks, right wing immune system responses, which I think fundamentally what conservative morality is. It's a form of behavioral immune system that blows back every now and again when the left goes too far. And it looks like the tides are turning, but I don't see how they turn so long as you're prosperous and wealthy. It continues to span and swim left. Government services and government payments and growth continues to grow so long as you have means to do that because it's a democratic dominant strategy. And you are selling fundamentally to low agency voters at this point, so you need a low agency product. Because again, democracy is the lowest common denominator of appeasement fundamentally.
Right.
In a high con in a society where you want your agentic to thrive, that's at best 20% of your vote, at best,
Hmm.
assuming the power, and it's probably a little less than that, frankly. You can't win on 20%, even if you get all of them. So you have to start appeasing the low agency more and more and more and more as you can. And you do that by buying their vote. And it's not going to be called buying their vote, but it'll dress up in a lot of different ways. It'll dress up also in nominally very stupid economic policies. A beautiful one that I see referenced a lot is like price controls on rent or certain things like that, where people, I see smart guys be like, haven't they read the economics textbooks? This policy doesn't work. What's wrong with them? Why are they promising this? I'm like, that is not the discussion being had whatsoever. What works for a politician is what gets him elected. That's what works. Not like, does it produce a long term benefit for like there's no attribution for that. Okay, like it's completely unfalsifiable on what caused that issue. Is that his problem? He can just campaign though on you deserve more. That guy gets less, you get more. Rent controls, whatever controls. I know it doesn't work economically. Obviously, it doesn't work economically, but it sells politically. And if you can
Hmm.
sell it politically, you do that. And it works if it gets you elected. That's what works. And that's kind of the mindset people need to have when they assess economic policies. What is the likelihood that the polity votes for this in their the constituency expands and they gain dependence? Does this policy create more dependence or less? Things should be distilled down on a very like binary reductionist framework almost this way, where dependence increase or dependence decrease. Dependence increase and you have the money, you do the dependence increase thing. So to sorry, that's a bit of a tangent to your question, but I think that answers your question because you're
Yes.
asking what causes this to
Yeah, that answers it.
what caused this? What caused this? Yeah, I don't think it's a financial development thing at all. Like the assets we've been talking about, that's a structural flaw of democracy. And when you start
Okay.
tampering,
Yeah, and so that leads into really the final thing I wanted to ask, which is we've talked about a lot of this kind of already, but just to look at kind of what's coming, at least in the short term. I think one thing that's very interesting we're seeing is men like Elon Musk, who are quite like some of the Gilded Age, robber barons in terms of their wealth and ability to translate that wealth into real world political power. Elon like owns the media through X and owns the government's ability to get to space and is creating these futuristic things with Tesla, which kind of makes him an even more powerful Gilded Age type
yeah,
person.
yeah,
One thing
Elon's
you,
intense.
yeah, one thing you saw with those people was some degree of caring about permanence. JP Morgan, I think, is a great example. He cared about the bank and the company, and he also set up a like aristocratic estate in England. I forget how many acres he owned, but it was a pretty large estate that did these things, and his sons kept up that tradition until they ran out of money. But so I think those people did care about permanence, even if their children were something of ne'er-do-wells. Do you think that any of that will return in terms of like most CEO managers of companies don't really seem to care about what happens to the company in 10 years, as we mentioned. Whereas I think, Vanderbilt did care about his family fortune in 10 years and so on. Do you think that some structural changes will come to how these great men of our time arrange things so that there can be an attempt at permanence? Or do you think this creative destruction mindset of the rise and fall of fortune and companies is at this point deeply embedded to the point where you're not going to see many attempts to change that, if any?
I think guys like that, once they get to that size, and Elon's not just a rich guy, like Elon is great man territory, like again, transcendent wealth. And to piggyback on what you were saying, and I was bringing up this essay while you were saying because it reminded me of it. Like Yarvin like criticized Elon for not understanding like how to how to exert power with Twitter. And I just want to clarify what Elon has accomplished with not inheriting it and all on his own through free market decisions. This
Mhm.
guy owns the most efficient way to get to space. This is from an essay I wrote called Elon Yarvin and Verbal versus Embodied Understandings. The most efficient way to get to space, the most valuable transportation company, Tesla, $1 trillion company, the most high impact social media company, the most sophisticated satellite communications company, the military's asking for help,
Mhm.
the most advanced mind machine company with Neuralink. And God knows what an AI. I think he's standing up the biggest cluster that exists for Grok
Yes.
with of a H100. So it's like I want you to imagine like if you were drawing up like a Tony Stark character or like Bane. Like what
Mhm.
if Bane how if Bane was trying to like get a structure in Gotham to where he controlled everything without controlling it. And then one day it's like, holy shit, this guy controls all the infrastructure. It's critical. Like
Yeah.
that's serious. Like Elon has more power than many heads of state. I would say most heads of state, frankly. Elon has more power than them. And it's done in like this extremely sophisticated a way that's just without precedent. Like all of the great men you just cited, I believe got wealthy off one or two industries that were
Yeah.
pretty straightforward and just exerted purely kind of economic influence to get to the political. Elon is exerting like structural infrastructure influence in addition to capital, in addition to political. So like if anyone could be a Caesar, it could be Elon. I don't think Trump is going to be much of anything in the cycle of our development, but Elon might be. Because I think if you analyze him appropriately, like he should be like you shouldn't criticize him because you should understand that like I don't think we can understand how a guy who's able to achieve that thinks fundamentally, you know. Um sorry, it's a bit of a tangent to your question. In terms of like, do these guys structure or do they start behaving in a way that is more salubrious for society, I guess, or makes it better populace? I do think when you have that degree of influence and power, the way you keep expanding is not by being parasitic or harming people. It's you need a healthy, strong society to keep making you healthy and stronger. Because again, these guys don't really have anything if they don't have a middle and lower class consumer base to buy their stuff and to use their products. So it's like gutting the middle class, again, is a very low time preference in the cycle of nations mindset for prosperity because longer term you are harming yourself, you're harming your stock, you're harming your human capital to view it, you know, it's not a good way to view humans, but from the level of a nation, you should view it that way. You're making your human stock worse off. So I do think by virtue of aligned incentives making the most sense for these guys, they should want to propagate fundamentally good things. And even if Elon isn't like a true free speech guy, which I don't even think he really is, honestly, I
Mhm.
don't. I think he's kind of liberal fundamentally, and but it doesn't matter though, because what he's propagating is actually good for everyone, right? What he did with
Mhm.
Twitter, what he's doing overall, these are healthy things for society. And I think he kind of understands that. I think he understands that if he pushes back on these negative things that are occurring, that are is not good for the United States. If I make the United States fundamentally healthier, I'm better off. My companies are better off. My massive constellation of networks improve. So when
Mhm.
you're Elon size, and vanishingly few men are, Bezos is probably the only dude you can mention in that same sentence. And it transcends just network, by the way, because like there's the fashion guy in France, I forget his name. Like he's really rich too, but that's not the same thing. Like
Right.
Bezos and Elon work in like infrastructure. Like his
Mhm.
Amazon's logistics network is insane. They're the third biggest employer, I think, but the U.S. government's by far the biggest employer, by the way, like four
Mhm.
times the runner-up of Walmart, which just speaks to the gate dependence strategy I just spoke of. And then Walmart, then Amazon. I think Amazon's number three. So these guys like have achieved power on like an extremely impressive scale. And I think once you get that wealthy and that influential, you start to really understand how you continue to improve yourself is by improving others. So it's my hope that an externality of that degree of influence understands that they only continue to do well if everyone else doesn't get worse off at the very least, right?
Mhm.
And I think it hopefully aligns its behaviors and incentives that make them start advocating for good and healthy things, even if they don't in their heart of hearts, really believe it. That's fine, as long as the behavior it promotes is good. As long as Elon is working towards free speech, not against it. I don't care what he says behind closed doors because his actions are the good thing. So I would hope that's how that manifests. And in terms of like permanence of like the money staying within their family, I don't know. I kind of doubt those guys care too much about that, frankly.
Yeah.
Maybe they do a bit, but that's an interesting question. I don't think Elon's ever spoken about that. I would be genuinely curious to hear him speak out loud about a guy with as many kids as he has,
Yeah.
how he's structuring that for inheritance. I've never heard Elon talk about inheritance.
I
I'd be
don't think he's
extremely
mentioned it.
curious. Yeah, he should talk about that. That'd be very interesting. It's hard to get into those guys' heads. It really
Uh,
is because I'm good at by and large extrapolating behaviors writ large for an average for general populace for game theory. But Elon and Bezos are not guys I can't see into their head. So I'd be
uh,
really curious to hear them actually opine on
yeah. Do you have time for one more question? This is
that.
something
Of
I thought
course,
of.
yeah.
Okay, cool. I know we've
Oh
gone
yeah, dude.
on
No,
for
no
quite a
stop at
while.
all. I'm
Yeah.
enjoying this a lot. I hope you are too.
Oh yeah, this has been great. So one final thing, and this is actually the final thing that I kind of thought of as you're talking is one feature of your work that I noticed, both reading it on Twitter over the past couple months and then reading your Substack a good bit more recently, is cutting through abstractions to see what's actually going on at like the behavioral level or why people care about a thing. So discerning what like a non-dividend paying equity actually is was very interesting, and that's kind of cutting through the layers of abstraction we use to understand it. And also, you spoke about arbitrage and the ability to see what something should be worth, I think, without those abstractions and kind of just going along with them. One issue I think people are having now is trying to figure out how to improve their relative wealth compared to others. That's, I think, one reason crypto has become popular is people think it's a way to outperform the market, which in some ways it is. There's a lot going on there. But do you think that cutting through those abstractions is wealth arbitrage opportunity for people? And how do you go about trying to cut through and seeing what's at the base level? I know that's a very broad question, so answer in whatever you
No,
think would be appropriate.
I think I get what you're getting at. It's kind of like we may be going too far to the rationalist abstraction. Okay, the accounting standards are the same. The
Hmm.
thing is really liquid, so it's the same thing as the cash payout. It's the same. Like that's
Yep.
we're getting probably too much in the direction of like long duration assets getting extremely valuable, even though they never pay out that money.
Yes.
And hopefully, if my thing succeeds, it should succeed in a very visible way and actually evoke this conversation for serious people. Because a lot of big accounts and influential people follow me, finance guys too. So if this succeeds, I hope they see this and it sparks this conversation. It has to succeed first, which I
Hmm.
passionately think that it will. But once it does, I think it'll recalibrate a lot of us to asking the question you just asked me. And I'm reminded of an essay I wrote recently called "Rationalist Empirical because you have to, rational because you get to." You operate in an empirical frame when things are hard, when you're in like a war environment, like a violent environment, an unsafe one, possibly a low trust one, right? Show me the money. We need protection. Like there's no luxuries here. We don't operate in the theoretical. We operate in praxis, empirical. Then, as you have more wealth and comfort, you become invariably more rational. You also become invariably more liberal. I also think conservative morality and conservative views operate on the same utility spectrum. That's another framework I write called masculine because you have to, feminine because you get to. Where conservative, like moral foundations and political beliefs, are much more useful, have higher utility in harder environments where you need to accrue wealth, where you need to amass resources. As you amass those resources, feminine because you get to. It's a good problem to have. How do we distribute these resources? We have too many. Talk
Hmm.
about again a good problem to have. That's
Right.
something only a reasonably wealthy society can ask. You cannot a poor society cannot ask that question. Trying to redistribute wealth when you're poor is like trying to grow a sunflower with no soil. And trying to sell conservatism when you're rich is like trying to grow a sunflower in the winter. It's just not an environment that's built for it. You're too comfortable. You're too comfortable. We do things because we have to. Um, and so I think we've gotten a bit too rational and theoretical and abstract with maybe notions of equity, notions of what we can manage and control with complex adaptive systems, notions of how much we can control the economy with our spreadsheet thinking and number go forever type stuff. I think this all ties in actually to your question,
Hmm.
where we're getting too abstract, too rational, too theoretical, and the empiric needs to return. Um, and I think on the financial side, the way we return to empiricism is through cash flows, is maybe through dividend payments, is
Hmm.
maybe through kind of the stuff where it's like, okay, like I need a little bit of collateral here besides like the really big stock number because I don't know, it's hard to get out of this thing.
Hmm.
A quote that sticks out to me, and I don't know why this sticks out to me, but I remember I was reading an anecdote from Elon. I don't even remember the essay, but where SBF, Sam Bankman-Fried, reached out to him for a partnership or something, saying he had 2 billion. And Elon was surprised that he had 2 billion liquid. He's like, does he have 2 billion liquid? Like, wow, that's okay. And this is a guy at the time worth like 25 billion, right? So it's like that shouldn't be that nuts. But
Hmm.
the fact that like that was surprising for Elon, and I don't know if SBF even did, but that was like a legitimate question for Elon, which
Hmm.
tells you a lot that like he would have been surprised if a guy with that net worth had that much actual liquid cash to do something with. So that
Hmm.
speaks a little bit to what we're talking about here, that a
Yes.
lot of this stuff is probably too abstract. A lot of it is too forward looking. Nvidia is worth $3.5 trillion. Like, don't get me wrong, it's an amazing company, but what does that mean?
Yes.
That's like, what does that mean in terms of like concrete anything? Okay, like
Hmm.
again, no dividend payments, no claiming resources. That's the sum discount of all the cash flows forever. Okay, well, maybe your grandchildren will be able to see that if it happens, if it gets paid out. Maybe. I don't
Yeah.
think so.
Yeah.
So we're probably getting too deracinated and too yeah, not connected to the empiric as much as we need to. And part of I think returning to conservative a framework entails one, things have to get a little worse to make us actually value the conservative and the things that made us great, make us
Hmm.
realize we're being too nonsensical and luxury conditions. What's the saying I say? Luxury conditions produce luxury problems and they produce
Hmm.
luxury solutions, right? So we have luxury conditions with all this luxury nonsense. And things are, not improving in many ways. And I think it's making conservative morality and conservative solutions become ascendant because, from a utility standpoint, they have greater utility for us collectively. And I think we'll see that with some empirical stuff as well on the finance side. So, very circuitous way to answer your question because I think they all tie in together
Yes, they
because
do.
I all think they're related to kind of the same thing. Kind of
Hmm.
the same thing. When liberalism goes too far left, it gets extremely decadent and theoretical and just has a poor theory of mind of people and embeds entropy. You have to revert right a little bit to an empiric conservative thing. Same thing with equities when they get like this ridiculous valuations where again, if people actually start analyzing this stuff, and maybe I'm the first guy to hopefully spark this discussion because I heard anyone actually question the core essence of equities. It's like, what is this though? Like, I mean, I don't understand how that is worth this much and what domain is that actually worth this much besides a market value price.
Right.
Probably we do need some return to empiricism on the cash flows and dividend type stuff to show me the money a bit. So I hope that made sense. If you have any follow-on questions, feel free. I know there was maybe a lot
No, that was great. Thank you. I think that's a good way to end it. Where can people find you?
there. On Twitter, I'm very active on Twitter and Substack. I cross post on both of those now. I'm Back the Bunny on Twitter. My name is Dimitri. And then on Substack, my Substack is called The Dosage Makes It So. I'm a huge equilibrium supporter and believer and balance advocate. So that comes from the quote, all things are poison and nothing is without poison. The dosage alone determines if it's poisonous, and I paraphrase that too. The dosage makes it so.
Hmm.
So any extreme produces some kind of dislocation you have to pay for. Is kind of the guiding light of a lot of that. So you can find me on Substack on the dosage makes it so, and my handle there is also Back the Money, and Twitter as well, and Telegram same handle. I'm the same handle on all social media, Discord, Telegram things. So if you want to reach out, feel free. If you have any questions about Salutary, DeFi stuff overall, anything that you think is interesting that you think I would like to hear about or maybe work with you on or talk about, I'm open to hear it all. So please don't hesitate to say hi.
Great. Thanks for coming on. Really appreciate it. Had a lot of fun talking to you.
My
Everyone,
pleasure.
thank you for listening, and I'll see you next week. Bye.